Listen, if you are over the age of 40, you are walking into a buzzsaw. The gap between broke and wealthy is widening faster than at any point since 1930. The next 18 months will wipe out the middle class entirely. You cannot afford to be wrong. I'm Dalio. I founded Bridgewater Associates, the world's largest hedge fund, where I manage $124 billion in assets. I predicted the 2008 financial crisis when everyone else was buying houses. I have studied 500 years of economic cycles to understand exactly where we are right now. And I am telling you, there is one specific mistake that destroys wealth for anyone over 40. I'm going to show you exactly what that mistake is and the 4 steps you must take to stop it. In 1982, I lost everything because I didn't understand this. I had to borrow $4,000 from my father just to pay my bills. Do not let that be you. Let's go back to that moment in 1982 because it is critical for you to understand the pain of getting the macro cycle wrong. At that time, I was arrogant. I had calculated that American banks had lent too much money to developing countries and that a default was inevitable. I went on television, I testified before Congress, and I told the world the market was going to crash. I bet everything on a depression. I was dead wrong. The Federal Reserve stepped in, the market bottomed, and we began the greatest bull run in history. I lost everything. I had to let every single employee at Bridgewater go. I was the only one left. I was so broke I couldn't pay for a plane ticket to visit a client. I had to go to my father, a jazz musician, and ask for a $4,000 loan just to feed my family. It was humiliating. It was painful. But it was the best thing that ever happened to me because it taught me radical humility. It taught me that I didn't need to be right. I needed to know what to do when I was wrong. That pain led me to develop the principles and systems that built Bridgewater into a $124 billion machine. I learned that the economy is just a machine with simple levers. And right now, looking at the data for 2026, the machine is flashing red again. But this time, unlike 1982, the threat isn't just a market correction. The threat is a structural destruction of wealth for anyone holding the wrong assets. If you are over 40, you do not have the time to recover that I had when I was in my 30s. You have less runway. You have higher liabilities. This is why you need to listen very carefully to what comes next. We are currently in the late stages of the big debt cycle. I call this stage 7 of the 8-stage archetype. This is the period characterized by tight money and widening wealth gaps. Historically, this looks exactly like the late 1930s and the late 1970s. When you look at the printing of money, the conflict between great powers, and the internal political polarization, the pattern is undeniable. The United States has $34 trillion in debt. The interest payments on that debt alone are now exceeding the defense budget. This is math, not opinion. The problem for you, specifically if you are over 40, is that the traditional advice is broken. Financial advisors tell you to hold a 60-40 portfolio, 60% stocks, 40% bonds. In a normal cycle, that works. Stocks go up, bonds provide safety. But we are not in a normal cycle. We are in a debt crisis cycle. In this environment, stocks and bonds can go down together. We saw this in 2022. It destroyed retirement accounts. If you lose 30% of your portfolio at age 45 or 50, you need a 43% gain just to break even. That takes years you do not have. This brings us to the specific wealth-destroying pattern I see everywhere. People think they are diversified, but they are not. They own a house, they own some S&P 500 index funds, and maybe they have a 401k heavy in tech stocks. That is not diversification. That is a concentrated bet on liquidity and low inflation. When inflation rises and liquidity tightens, all of those assets fall together. This is the trap. You feel safe because you own different things, but you actually own the same risk factor. The gap is widening. The people who understand how to structure a portfolio for this specific stage of the cycle are pulling away. They are compounding at 12 to 15%, while the average person is seeing their purchasing power erode by 7 to 10% annually through real inflation. If you sit still, you are moving backward. The machine is grinding your wealth down through currency devaluation. You have to move. But moving blindly is how I lost everything in 1982. You need a map. You need a framework. So, what is the one mistake? The one mistake that destroys wealth after 40 is concentration without hedge protection. This sounds technical, but it is simple. It means you have all your eggs in a basket that depends on the economy being good. When the economy turns bad or inflationary, your basket breaks. I have developed a 5-factor framework to explain why this concentration is lethal right now. Factor number 1 is correlation convergence. In a crisis, correlations go to 1. Everything you own that is tied to the dollar or the stock market moves in sync. You think your real estate balances your stocks, not when interest rates spike. Rates go up, stocks go down, real estate freezes. You are hit on all sides simultaneously. This is what happened in 2008, and it is setting up to happen again on a larger scale due to the sovereign debt crisis. Factor number 2 is the cash drag illusion. Many of you are scared, so you go to cash. You put $100,000 in a savings account. You feel safe, but with real inflation running at 5 or 6%, regardless of what the CPI says, that cash is rotting. In 10 years, that $100,000 will buy only $60,000 worth of goods. Cash is not a safe haven. Cash is a guaranteed loss. As I have said before, cash is trash. You need to be in assets that reprice with inflation. Factor number 3 is geopolitical discounting. Most domestic portfolios assume the U.S. remains the sole dominant superpower forever. My study of the last 500 years, from the Dutch Empire to the British Empire to the American Empire, shows that empires decline. We are in the decline phase. When a reserve currency is challenged, domestic assets get repriced downwards. If you do not have international diversification and non-dollar assets, you are betting your entire financial life on a single political outcome. That is reckless. Factor number 4 is liquidity mismatch. If you are over 40, you might need access to capital for your business, your children's education, or health issues. When markets crash, liquidity dries up. If you are concentrated in illiquid assets like real estate or private business equity without a liquid hedge, you will be forced to sell at the bottom. This is the fire sale dynamic. You sell your best assets at the worst time because you ran out of cash. This is exactly what happened to me in 1982. Factor number 5 is asymmetry neglect. This is the most important one. Most people bet on things that have limited upside and huge downside. You want the opposite. You want asymmetry. You want small bets that can pay off 10 to 1 or 20 to 1 to protect the rest of your portfolio. Insurance is a form of asymmetry. Gold is a form of asymmetry in a currency collapse. If you don't have these asymmetric hedges, a 50% drop in the market destroys your retirement math forever. Before I tell you the specific assets to fix this, you need to understand the human cost of getting this wrong. Let's look at a concrete example. Let's talk about David. David was a client I observed in the early 2000s. He was 52 years old. He had saved $1.2 million. He was doing everything right by conventional standards. He had $800,000 in equities, largely tech and growth-focused, and $400,000 in his primary residence. He had 0 gold, 0 commodities, 0 inflation-linked bonds. He was fully concentrated on growth. When the dot-com bubble burst, his equity portfolio dropped 50%. He panicked. He sold at the bottom. His $800,000 became $400,000.
Then he sat in cash for 5 years, missing the recovery. By the time he was 60, his purchasing power had been cut in half. He had to delay retirement by 9 years. 9 years of his life traded for a mistake in portfolio construction. He didn't lose money because he was stupid. He lost money because he was concentrated without protection. Now contrast that with Sarah. Sarah was 48. She had a smaller portfolio, $750,000, but she followed the all-weather principles. She had 30% in stocks, 40% in long-term bonds, 15% in intermediate bonds, 7.5% in gold, and 7.5% in commodities. This is a balanced mix. When stocks crashed, her bonds rallied. When inflation spiked later, her gold and commodities rallied. In 2008, when the S&P 500